All right, so today we're going to do a deep dive into some pretty intense financial waters.
Yeah.
We are talking about JPMorgan Chase,
Oh, wow.
which is a behemoth of a bank with over $4 trillion in assets.
Yeah, that's more than twice the GDP of the entire United States.
Than twice the GDP of the entire United Kingdom.
Yes.
It's a lot of zeros. So we're breaking down their fourth quarter, twice the 2024 earnings. Fresh off the press.
Right.
See what story these massive numbers tell.
All right.
We've got excerpts from their earnings release and that juicy financial supplement. So buckle up. Now, you might be thinking, why should I even care about some bank's earnings report? It might seem like a world away from your daily life, but trust me, it's more connected than you think.
Yeah, you're absolutely right. JPMorgan Chase isn't just any bank. It's the largest in the U.S. And what happens there sends ripples throughout the entire economy. Their earnings report is like a window into the financial health of the nation. It gives us clues about consumer spending, lending trends, and even how the market feels overall.
So by understanding JPMorgan Chase, we can get a glimpse of where the economy might be headed. Plus, who doesn't love a good money story, right?
Well said.
All right, let's start with the big picture. JPMorgan Chase pulled in a net income of $58.5 billion in 2024. That's a hefty 18% jump compared to the previous year.
Wow.
Earnings per share also climbed significantly, reaching $19.75, up from $16.23 in 2023, and their total revenue, a cool $180.6 billion, an 11% increase. Those are some impressive numbers. Is this all sunshine and rainbows, or are there storm clouds on the horizon?
Well, it's not all smooth sailing. While the growth is certainly there, fueled by those rising interest rates we've all been hearing about, and a surge in lending activity. The bank is also setting aside more money for potential credit losses. It's a bit like stashing away an umbrella, just in case.
So they're celebrating the good times, but preparing for potential bumps in the road. Smart move. What do you think, listeners? Is this a sign of strength or a reason to be cautiously optimistic? Let's break down their different business segments to get a clearer picture. First up, we have Consumer and Community Banking, also known as CCB. This is where things get a little interesting. While JPMorgan Chase as a whole saw profits soar, CCB's net income actually dropped by 17%, landing at $17.6 billion. That seems a bit counterintuitive, doesn't it? What's going on there?
It's all about those credit loss provisions we mentioned earlier. CCB is particularly focused on home and auto loans, and they're seeing some signs of potential trouble in those areas. It seems they're a bit more concerned about consumers' ability to keep up with their debt payments.
So are people tightening their belts?
Not necessarily.
Yeah.
Interestingly, mortgage fees and card income within CCB are both showing strong growth, up 17% and 24% respectively. This suggests that consumers are still spending, even with the economic uncertainties out there.
So it's a bit of a mixed bag. Consumers are spending, but the bank is also bracing for potential defaults. Makes you think, right. Okay, let's switch gears and look at the Commercial and Investment Bank, or CIB. They had a phenomenal year, with net income surging by a remarkable 23% to reach $24.8 billion.
Yeah, CIB
Yeah.
capitalized on a bustling environment,
Mm-hmm.
mergers and acquisitions. Investment banking fees also jumped a significant 37%.
Sounds like the deal makers were busy. Let's move on to Asset and Wealth Management, or AWM. They delivered steady growth, with net income rising 4% to $5.4 billion. Not as dramatic as CIB, but still a solid performance.
Exactly. This steady growth in AWM reflects a larger trend we're seeing. People seeking out ways to protect and grow their wealth in a somewhat unpredictable market. AWM provides that sense of security and potential for growth, making it a popular choice.
Now hold on to your hats, because the corporate segment is where things get really intriguing. Their net income skyrocketed by an astounding 276%, reaching $10.6 billion in 2024. That's not just growth, that's a full-blown explosion. What on earth happened there?
You know, there's a fascinating story behind that massive increase. It's primarily attributed to a one-time gain of $7.9 billion from their Visa shares. This gain alone significantly boosted the segment's profitability, highlighting how specific events can sometimes create outliers in financial performance.
It's a great reminder that there's always more than meets the eye when it comes to these numbers. It's not just about the headlines. It's about understanding the nuances and the underlying factors driving performance. Now let's shift gears and talk about capital and risk management. JPMorgan Chase boasts strong capital ratios, exceeding regulatory requirements. However, their average value at risk, a measure of potential losses, did increase, suggesting they're taking on a bit more risk. Here's where it gets really interesting. They're estimating a potential $2.2 billion hit to their earnings if interest rates were to rise by a full percentage point. It's a pretty big bet on where interest rates are headed, wouldn't you say?
Absolutely. This figure reflects their strategic decisions on capital allocation and their appetite for risk. It leads to some critical questions. How will these decisions play out in the long term? Are they being overly optimistic about interest rates?
Great points. We'll have to wait and see how it all unfolds. Before we move on, let's take a quick look at their stock performance and share buybacks. JPMorgan Chase's stock price soared 37% year over year, and they repurchased a whopping $18.8 billion worth of their own shares throughout 2024.
These moves signal a lot of confidence in the company's future. Share buybacks in particular can boost earnings per share, making the stock even more attractive to investors.
So they're putting their money where their mouth is. They believe in their own success, and that confidence resonates with investors. We've covered a lot of ground in this first part of our deep dive. We've seen soaring profits, cautious optimism, and some intriguing insights into the different facets of JPMorgan Chase's business. But we're just getting started. Stay with us as we continue our exploration in part 2, where we'll delve deeper into their financial statements and uncover even more fascinating details.
Looking forward to it.
Yeah, me too. Welcome back. We're ready to put on our financial detective hats and delve deeper into JPMorgan Chase's performance. Let's crack open those financial statements and see what secrets they hold.
I love a good financial mystery. One of the first things that jumps out is their balance sheet. As of December 31st, 2024, JPMorgan Chase held a staggering $4.002 trillion in assets.
Whoa, that's an astronomical amount of money. What's driving that incredible asset growth? Are people just throwing money at them?
It's not quite that simple. A key driver is loan growth. Their total loans reached $1.347 trillion, a 2% increase from the previous year. Credit card loans in particular saw a significant jump, rising by 10% to $232.8 billion. This suggests that despite some concerns about potential delinquencies, the bank is still actively lending and, in a way, betting on the continued spending power of consumers.
So they're carefully weighing the risks and rewards. Makes sense. What about deposits? Are people flocking to JPMorgan Chase to park their hard-earned cash?
Interestingly, total deposits remained relatively stable at around $2.406 trillion. However, there's a fascinating shift happening within those deposits. Non-interest-bearing deposits, think your basic checking accounts, declined by 8% year over year. Meanwhile, interest-bearing deposits, which offer a little extra bang for your buck, increased by 3%.
So people are getting smarter about where they keep their money. They're moving away from those low-yield checking accounts and seeking out better returns in this higher interest rate environment. It's like they're playing a financial game of strategy.
Exactly. It seems consumers are becoming more financially savvy, aligning their choices with the current economic landscape. It's not just about saving anymore. It's about making your money work for you.
Now let's zoom in a bit and examine the average balance sheet figures. I know averages might sound a bit boring, but they can actually reveal subtle trends that we might miss by just looking at the year-end snapshots. What kind of insights can we glean from these averages?
Great question. Looking at the average figures for 2024, we see that interest-earning assets, think loans and investments, grew by a healthy 6% to $3.571 trillion. This was fueled by increases in deposits with other banks, federal funds sold, securities borrowed, and of course loans. It's like they're diversifying their portfolio, spreading their bets across different areas.
They're certainly keeping busy. What about the all-important interest rates? Are they making more money on those assets?
Absolutely. The average rate on those interest-earning assets rose to 5.31%, a significant jump from 5.14% in 2023. But as we discussed earlier, their cost of funding is also going up, with the average rate on interest-bearing liabilities climbing to 3.36%. For 3.14%. It's a delicate balancing act.
So their expenses are increasing, but they're also earning more on their assets. Does that mean their profit margin is widening? You know, that difference between what they earn and what they pay out?
You got it. We call that the net interest margin. And it did indeed expand to 1.95% in 2024, up from 2% in 2023. This is a clear indication of the bank's ability to benefit from rising interest rates, even as their funding costs increase.
We're riding that interest rate wave. Let's revisit capital and risk management, but this time from the perspective of those financial statements. What can we learn about their financial strength and risk appetite? from these numbers?
Let's focus on tangible common equity, or TCE, a key indicator of a bank's stability. It's essentially a measure of their high-quality capital that can absorb potential losses. As of December 31st, 2024, JPMorgan Chase's TCE stood at $272.2 billion, a 10% increase from the previous year. This growth suggests that the bank is building a stronger capital buffer, like a financial safety net, to navigate potential economic storms.
It's like they're fortifying their financial fortress. That's reassuring to hear, especially given those concerns about credit losses. It shows they're taking risk management seriously. Now, before we move on, let's touch on those share buybacks again. We saw that they repurchased $18.8 billion worth of their own shares in 2024. Can we get into the nitty-gritty of those figures?
Absolutely. The share repurchase program was very active throughout 2024. They bought back a total of 91.7 million shares, paying an average price of $205.43 per share. This is significantly higher than the average price of $142.31 they paid in 2023, showing that they're willing to invest in their own stock, even as the price appreciates. It's a strong vote of confidence in their future.
So they're not just talking the talk, they're walking the walk, investing their own capital in their future success, their strong capital position, those share buybacks, and their steadily growing earnings. All paint a picture of a bank that's firing on all cylinders. But as we've seen, there are some potential risks lurking beneath the surface. Are they prepared to weather those storms?
That's the million-dollar question. In part 3, we'll shift our focus to those potential risks and see how JPMorgan Chase is addressing them.
Sounds good. We'll be back in a moment to dissect those risks. So stay tuned for the final part of our deep dive into JPMorgan Chase's fourth quarter 2024 earnings. Okay, so we're back for the final part of our deep dive into JPMorgan Chase's fourth quarter 2024 earnings. We've seen, their triumphs, their calculated bets, but now it's time to kind of flip the script a little bit and scrutinize those potential risks. Remember those credit loss provisions we talked about, particularly in consumer lending? Let's unpack those a bit further.
Yeah, you're right to focus on those provisions. They're like a canary in the coal mine, signaling potential trouble ahead. One of the first things to examine is the net charge-offs, essentially debts they've written off as uncollectible. For JPMorgan Chase, these reached $7.9 billion in 2024, a whopping 48% increase compared to 2023.
A 48% jump. That's a significant leap. It's like that little crack in the windshield, suddenly spider webbing across the whole glass. Where are these charge-offs concentrated?
The biggest culprit is card services. Charge-offs in this area surged by 52% to $7.1 billion. It seems that while card income is up, suggesting robust spending, more people are also struggling to keep up with their credit card payments.
So it's a bit of a double-edged sword. Increased spending is great for the economy, but if it's fueled by debt that people can't repay, it could create a ripple effect.
Exactly. It's all interconnected. And this is where those rising interest rates come back into play. Higher rates make it more expensive to carry debt, and that can put a strain on household budgets.
Let's dig deeper into those delinquency rates. Are more people falling behind on their payments?
We're seeing some mixed signals. In home lending, the 30-plus day delinquency rate remains stable at 0.77%. But for card services, it ticked up slightly to 2.17%, compared to 2.14% in 2023. And for auto loans, it actually increased to 1.43%, from 1.19% in 2023.
So it's not a full-blown crisis, but there are definitely some warning signs flashing. It seems like JPMorgan Chase is right to be cautious.
Absolutely. Those increased provisions for credit losses aren't a sign of panic. They're a sign of prudence. It's like they're battening down the hatches, preparing for a potential storm.
We also talked about their value at risk, or VAR, going up. Can you remind us what that means and what those detailed figures tell us?
Yeah, VAR is a way for banks to measure their potential losses from various risks. And JPMorgan Chase uses a specific type called earnings at risk to focus on the impact of changing interest rates. They essentially run simulations to see how their earnings would be affected if interest rates went up or down.
So they're playing out different scenarios, kind of like a financial choose-your-own-adventure. What did those scenarios reveal?
Well, they estimated a potential $2.2 billion hit to their earnings if interest rates were to rise by a full percentage point. On the flip side, if rates were to drop by a percentage point, they could actually see a $2.4 billion gain.
So they're exposed on both sides, but it
Yeah.
seems like they're more concerned about rates going up than down. Is that a fair assessment?
It is, and it makes sense given the current economic climate. Inflation is still a concern, and central banks around the world are signaling they'll continue raising interest rates to combat it. For JPMorgan Chase, those rising rates could squeeze their profits, while falling rates could provide a boost. It's a delicate balancing act.
Yeah, it highlights the importance of their risk management strategies. They need to be nimble and adaptable to navigate these uncertain waters. So we've explored both the strengths and potential weaknesses of JP Morgan Chase's latest earnings. What does it all mean for our listeners? How can they connect these insights to their own financial lives?
That's a great question. JPMorgan Chase's earnings aren't just a story about one bank. They're a reflection of the broader economy, the trends we've discussed, from consumer spending and debt levels to interest rate risks, and the bank's own strategic decisions have implications for everyone.
It's like those ripples we talked about earlier. What happens at the top of the financial food chain can eventually trickle down and impact individuals in their daily lives.
Exactly. As you make financial decisions,
Hmm.
whether you're investing, saving, or taking out a loan, being aware of these trends can help you make more informed choices. It's about understanding the forces shaping the financial landscape and positioning yourself accordingly.
So it's not just about watching your own bank account, it's about having a broader perspective on the economy. JP Morgan Chase's earnings provide a valuable window into that world.
Precisely. We encourage you to stay informed,
Yeah.
ask questions, and never stop learning. The more you understand about the financial world, the better equipped you'll be to navigate its complexities and make sound decisions.
Well, that wraps up our deep dive into JP Morgan Chase's fourth quarter 2024 earnings. We hope you found this journey insightful, engaging, and maybe even a little bit entertaining. Remember, knowledge is power, and understanding the financial world is an essential part of navigating today's complex landscape. Until next time, stay curious.